Okay, hello everyone and welcome back. My name is Greg Furman and this is the Vantage Point AI Market Outlook for the week of January the 19th, 2026. Now, to get started this week, we're going to do things a little bit differently. Now, what I want to talk about here briefly, again, the comment section in here is usually open, and that's for constructive, positive, and comments of that nature. But every once in a while, a comment is just so far out there that it needs to be addressed. And the comment was that the past is not the future and the US dollar is a go. So let's really look at that for a second, shall we? And again, all technical indicators, guys, are based on past data. The whole theory behind it is that history repeats itself. Now, if we look at a 200 plus year study of excess returns of a multi-asset portfolio, the seasonality is at the top of that list on a performance basis, which is based on past price data, past price patterns, patterns that repeat each other. We've all heard of sector rotation in stocks. Each quarter, certain stocks do better than other stocks. This is a real thing here, guys. So again, we're certainly all entitled to our opinions, but we most certainly are not entitled to our own set of facts. And these are facts. Now, when we look at further into this, my argument here is that the dollar predominantly does not do well mid-month, and there's a reason for that. If we look at this from, this is an intern actually from Goldman Sachs, the dash for cash, monthly market impact of institutional liquidity. Again, we want to look at facts, not opinions that are not based on anything other than that, somebody's opinion. When we look at this gentleman also, we present broad-based evidence that the monthly payment cycle induces systematic patterns in liquid markets around the globe. First, we document temporary increases in the cost of debt and equity capital that coincide with key dates associated with month-end cash needs. So again, what that means here, guys, is again that at certain times of the month, dollars, for example, are required. Nobody is required to buy a stock, an ETF, a futures contract, but they are required to buy Canadian dollars, US dollars, euros to settle trade balance. With the US, we have pension money that has to be paid out at the beginning of the month. So when we look at this just over a one-year basis, I noticed the same thing this intern from Goldman Sachs did. He wrote that article in 2018. I noticed it long before that, but the fact is I noticed it. So when you look at a chart here, guys, and again, when we're talking about the past is not the future, that is not based on any type of relevant fact that I'm aware of with regards to trading. This pattern is very clear. At the end of the first week of the new month, the dollar tends to cycle, or the cycle tends to be that the dollar weakens. So when we look at that here, going back into December or January, February of 2025, we can see the dollar struggles after that first week. We see it again in March, a big drop. When we look at it in April, the same thing. The week after this week that we just finished actually is usually the end of the dollar rally. We can see right here in May, the dollar had an extra week of liquidity or an extra week of buying, but ultimately it dropped again. So then again, when we keep going with this into June, the same thing. After the week of the 13th, the dollar tanked. We see a little bit of a difference there again in July as we come up into the week of the 18th, but basically it's showing us that the dollar in the third and fourth, well, about 2.5 weeks in, the dollar really struggles, right? We look at it in August after the 8th, same thing again. When we look at it in September, same thing again. When we come over here into October, same thing again. When we start moving into the next week, it points towards weakness in the dollar. Again, the same thing occurred in November. When we look at December, of 2025, same thing again. So this, if it happens once, guys, it's a coincidence. If it happens 10 out of 12 months of the year, it's no longer a coincidence. So we need to look at these things and gauge that, because all future price points are based on the past data. If we look at how we forecast the weather, well, we don't wait for it to start snowing and saying, well, okay, I think it's going to snow because it's snowing. No, what we do is we look at historical price, or we look at historical weather patterns in the month of January. What usually happens in Canada, what happens in Florida, what happens in Hawaii. But the fact of the matter is, we can gauge what the average temperature is going to be. How much rain are we going to get? How much snow are we going to get? And it has a degree of accuracy of about 80%. So again, when we're talking about fact-based trading and saying that the past does not influence the future, there is absolutely nothing based in fact that would suggest that that statement is true. So we need to have an open discussion about this. This is a weekly outlook for 1 week only, guys. And it's intended to be for educational purposes, to show you things like this that are fact-based. To say that there isn't a regular price pattern, and this is just 1 year. I've seen this going on for over 20 years now. And again, if we're not looking at these price patterns, then how would we ever get a portfolio to have this kind of success? When we layer in intermarket technical analysis with seasonal patterns or repetitive price patterns, if nothing else, even though we're still speculators like everybody else, it does give us a significant edge, right? That is the whole theory behind that. So if we look at over the last several months, I've implemented the USDU as a better alternative to the US dollar index, and I will demonstrate this right now. When we look at the USDU, if you Google the Wisdom Tree US dollar bull fund, then it shows all the liquidity needs for the US dollar against all the other global counterparts. It's not all weighted to the euro. The dollar index, the UUP ETF, is all weighted to the euro, guys. So if you're trading euro US, I guess it's okay, it's good for that. But the USDU measures the broader dollar strength and weakness. So we can see this past week, as I had discussed exactly in last week's outlook and said, I believe we will come back up to the T-cross long and we will fail there. I said that before it happened, not after, because I have seen this pattern over and over and over and over again. It's not about being right or wrong or trolling internet, YouTube websites, giving your opinion that's not based on fact. It's about facts, cycles, repetitive moves in the market. So as I discussed in last week's outlook, that this USDU is giving me a better idea of how the dollar is actually doing. So again, when I measure that against the UUP, I could see how somebody may be somewhat confused by this, because this is giving a different signal. But there's an MA diff cross on both of these guys. But with whether it's right or whether it's wrong, the first thing we have to do is identify this particular pattern. And again, that is a clear warning sign that this move up in the dollar, as small as it was this particular week, this past week, actually the dollar didn't even make gains against the Kiwi or the Aussie and in several other currencies. But this is considered a failure, and that was discussed again before it happened, not after. This is an outlook, not a recap of something that already happened. Now an MA diff cross is forming, so the probability that the US dollar follows the same pattern, and again, it's not about being right or wrong here, guys, or my tools are better than your tools. It's about understanding these repetitive liquidity needs. That is, again, there's been an article written on that. And then if we look at this past trading week, which I will absolutely concede that there was enough fundamental data this week that should have sent the dollar to the moon, and it didn't. And I will further advise that on multiple occasions over the last 20 years, I've seen the US dollar at its best and at its worst. But what I have seen is the US holding firmly above 5% interest rates and creating 600,000 to 900,000 jobs per month. There was absolutely zero reason for the US dollar to move lower. And in the second and the third week of that month, it always did. So it tells me that they're using that liquidity to buy dollars when they need it. But when they're done buying the dollars that they need to settle trade balances, pensions, etc., they throw it back to the wolves. And we know that the wolves prefer to sell dollars than buy them. So again, this past week, further to sweeten the pot to try and get to bait people into dollar longs, JP Morgan Chase comes out and says, okay, well, the Fed is not going to cut interest rates in 2026 and he's going to hike in 2027. Not even that could push the dollar higher. And that, with all due respect, is wrong. The Fed is not going to hike in 2027, and he's likely to cut at least 2 or 3 times in 2026. And again, one data point is not enough to change that. So when we look at this, until such time as the dollar clears the T-cross long on this particular ETF, there is a further warning sign that we are losing momentum, and this was corrective in nature. So again, these are the things that we need to make sure that we're understanding. And again, it's finding these historical repetitive price patterns, but to even suggest that the past is not a window into the future is utterly ridiculous. And it is not based on any factual documents or price patterns that I have currently seen. So with that said, we have some idea how the dollar looks here, and it is going to be about interest rates. Now, when they made that comment, they managed to push gold a little bit down here. As you can see that once again, gold is struggling a little bit up here, but the media is trying to influence people. If JP Morgan is trying to push the dollar strength, then chances are, guys, they're going to be short on that, and they're trying to get the market to go the other way because it doesn't match the price patterns that I showed, right? But the other more recent example I can give you of this is Goldman Sachs putting out, when oil was trading last month at 50-something dollars a barrel, they put out a price projection target of $30 a barrel for oil. I immediately said, buy oil right now. And oil immediately reversed and is back up over $60 a barrel. It's a setup, guys. We've seen this time and time again of the media trying to influence us to go the wrong way. So gold right now is correcting mildly lower based on those comments that the Fed is not going to cut and a hike is coming in 2027. I don't see any evidence that that is going to happen, and I need a lot more data in 2026 to even think about a hike in 2027. So gold remains firm, well above the T-cross long. That's coming in at 45.04. The equity markets reacting to the news of the Fed, but you can see again, that was the downside in the equity markets was short-lived. We came right down to the yearly opening price, hit it to the number at 685.71, and we've rebounded back up off of that. This is what we would expect, because again, I would further argue that if any calendar year the dollar does well, it usually does okay in January. Not great, but it does okay, and it does very well in mid-September through mid-October. But those are the 2 better months for the dollar. So this would tell me gold could have a little bit more down pressure, S&P could have a little bit more down pressure, but we need to know where the line in the sand is, and the line in the sand is at that yearly opening price, 685.71. As long as we're holding above that, then longs are still in play. When we look at Bitcoin, again, Bitcoin is doing actually fairly well here. It's trying to hold on to its gains. A little bit of a concern here is that I would like to see Bitcoin above 100,000 to get past that psychological level, but we are above our T-cross long. Now again, when you have a high bar of trading, a big volume bar like this comes up, hits and fails, in most likely we're going to see a retracement to the mean, and that's between these two custom predicted moving averages, the long predicted and the T-cross long. So the T-cross long predicted coming in between 94,000 and 92,000. That is likely a retracement area for next week, and longs remain in play well above 87,683. But be very, very cautious with Bitcoin longs, because again, looking at those historical patterns, past price patterns that are paramount to our success, ignore them to your own detriment, guys. Again, you can troll different websites and give your opinions, but there's very little facts supporting that. Bitcoin, 3 years up, 1 year down. 3 years up, 1 year down. Last year was the third year of a 3-year rally, but we had a sell-off of about 36% between October and January 1. That's what I would have expected in 2026. So Bitcoin remains bullish well above the T-cross long and the long predictive. Now, when we look at the German equity markets, once again, the global XDAX ETF, which I've somewhat promoted on here, because much like the USDU, it's giving me a different signal than what the future side is, and it's been highly effective. So the DAX for now, should the dollar move lower next week, that would support the DAX longs, S&P 500 longs, Russell longs, NASDAQ longs, even technically Bitcoin longs. They're all tied together. But for now, you can see the predicted RSI is still good. Predicted differences are still above the zero line. Neural index starting to turn back up. So your key levels here, the T-cross long, 46.33, and of course that all-important yearly opening price, 45.86. As long as we're holding above that, whether you're in the DAX ETF or DAX futures, both remain a long trade. Yes, it's toppy up here, but again, watch your downside targets and try and stay with the primary trend. If I look at the VIX from this previous week and looking forward into next week, we had a singular spike up here and we did not close above that T-cross long. Right now, the VIX on this particular ETF is stuck between the T-cross long at 26.49 and the yearly opening price at 25.23. We're looking for a break of either one of these two levels as potentially as early as next week or the week after, and that will tell us where we're going. Now, my concern for the global indices here is that the predicted differences are above the zero, and the predicted RSI has had a retracement to the 40 level and bounced off of it, and it's actually showing a little bit of momentum. So start of the week, we have a US holiday on Monday. I believe it's Martin Luther King Day. So Tuesday, Wednesday next week is where your real price is likely to start to show itself more towards Wednesday. So be careful with this one on Monday, because there's definitely going to be some volatility there. Now, when we look at oil prices, once again, on the last one on the commodity side, oil prices, again, it was over here just a week or two ago. I believe it was around this area. It was December through to the end of December when oil prices were down. Goldman Sachs put that release out, $30 a barrel is the target for 2026. And again, it was a setup, guys. The market completely reversed because they were probably never short to begin with. They were likely on the long side of this, and they're baiting the market in to take the other side of that trade. So oil prices remain very firm, and they're only going to go higher the closer we get to May here, guys. So for next week on the USO, our T-cross long 70.72 and the yearly opening price 68.43. All of our support is sitting right there. Okay. Now, when we look at the euro going into next week, the monthly seasonal pattern, what I can tell you here, that again is one of the most powerful strategies out there. VantagePoint offers numerous powerful seasonal tools with the predicted true range at the top of that list. But again, it has very, very heavy support on the euro down into that all-important seasonal projected low, which is around about the 115.20. So any move lower on this is, in my respectful opinion only, is better to be on the long side. We still have the MA diff cross. Yes, it's under pressure, but when we look at the trading for the week here, guys, this is where it gets very interesting. All your price pressures on the euro have been, we came out of the gate, right out of the gate, opening the week at the about 116.25 we opened on the week actually, and then we went straight up to 117. So the bulk of the trading volume to the upside. Then we've slowly grinded lower, and then finishing the week out down about 20 pips. So not exactly a US dollar go. The same thing with the British pound, pretty much ending the week flat. The going forward into this, we're looking for reversal indicators is what we're looking for, guys, to see if there's anything. So if the dollar is going to weaken, again, it's usually into the second week of the new week, but mid-month, by the charts that I've shown you on here, take it for what you want, predominantly the dollar does not do well. That's what I've traded over and over again. Do I buy dollars during the course of the month? Of course I do, guys. I buy at the end of the month, into the first week of the new month on a regular basis every month. But I predominantly sell the dollar mid-month every month also successfully based on the pattern. So the euro and the pound, same trade. They're basically finishing the week down about 15, 20 pips each. After making a significant gain. The British pound at the beginning of the week, starting the week off the open, right off the opening of the week, 133.98, and then went on an absolute tear all the way up to almost 135. So again, selling dollars right out of the beginning of the week was the play, guys. And it's not about being right or wrong. It's understanding how this thing kind of works. Then the dollar. Then the announcements came out about from JP Morgan saying, oh no, the Fed's not cutting in 2026. I'll take the other side of that bet. I bet you they cut at least 2 or 3 times. And would I bet that there will be no rate hike in 2027? Absolutely, I'll bet on that. And I don't think this current president is going to be on board with any talk of a rate hike. Right? So we look at that, the pound kind of goes a little bit flat. So if it's going to turn around, we look for our VP indicators next week to further put more upside pressure. But again, the yearly opening price, 134.48, guys, that's the line in the sand. And by the end of this quarter, the end of the first quarter into March, I can tell you with a degree of certainty that we are likely to be closed above that particular area. Now, the dollar yen. With the dollar yen, again, the dollar coming out of the week on this one, 245, you can see we've got some pressure. So this is a place where you could potentially have bought dollars at the beginning of the week, but that's because it's a carry trade. The yen is virtually zero interest rates. The US is the higher interest rates. That's the carry trade, right? But even at the end of the week, the dollar finished negative against the yen. A lot of chatter about intervention, and I could see it coming. But this is a mess the Bank of Japan has created for themselves. They only have themselves to blame for the currency being at this level, right? But again, a lot of participants very nervous about what the Bank of Japan's next move is. So be careful of that. But for now, this is pointing down. Neural index is down. Predicted differences are pointing down. A falling predicted RSI. But again, where's the yearly opening price on this? 156.88. That's your line in the sand, guys. This red line right there. So for the savvy trader who believes that the dollar is going to lose ground against the yen, you would put your sell stops below 156.88, and if the market passes by there, it'll pick up your short as it does. But again, if the market believes the Fed will not cut interest rates and a possible hike, then the dollar will hold its ground against currencies like the yen. Also against currencies like the Swiss franc. The dollar was able to make some gains over here, but again, another high yielding currency. So when we say the dollar is a go, well, that's a very vague comment. The dollar isn't good to go where? Well, it's maybe good to go against the yen and potentially against the Swiss franc, but not necessarily against the other currencies. So again, that's a very vague statement. So when you look at this right now, even this is struggling to make any real gains. We opened the week at, let's see, 1, 2, 3, 4, 5. Yes, we opened the week at 8,005. and we closed the week at 80031. And again, another low yielding currency, right? The US Canadian pair, you can see that really the dollar's done 1, 2, 3, 4, 5 right there. You can see that the dollar's done nothing. And in actual fact, most of your pressure on this pair was selling the dollar, not buying it. And again, we didn't finish the week making any gain. The dollar made no gains against, in my respectful opinion, one of the weakest currencies in the Forex market, the Canadian dollar, based on the tariffs and everything else, right? But for now, again, a mixed signal. But if this pair can't get moving, then and I can pretty much tell you 2 months out in advance here, guys, that regardless of what happens with the tariffs, the Canadian dollar is likely to strengthen against the American dollar towards the end of the first quarter in the month of March, as oil prices start ramping up. We go from winter gas to summer gas. All of this, again, past price patterns, guys, to even remotely suggest that they don't influence intermarket correlations, seasonalities, or give us a direct insight as to what a market is about to do is utterly ridiculous. When there's an overwhelming amount of evidence to the contrary. Okay? Now, when we look at the Aussie and the Kiwi, this is a pretty easy trade all week, guys. We've got 1, 2, 3, 4, 5. There's our opening for the week. We've got a buy there on Tuesday. We've got a buy on Wednesday. We've got a buy on Thursday. Each one of these trades running along. And again, from where the US dollar was unable to make any gains against the lowly Aussie currency. And the same thing is happened even stronger with the Kiwi. So when you look at that, we've got 1, 2, 3, 4, 5. We started the week right there. And as you can see, there's a buy every single day off the Monday bar low. Because the US dollar is not making any gains against either the Aussie, the Kiwi, struggling against the Canadian dollar, up most of the week against the euro and the pound. So again, there's a rationale why that happens. And again, that would always lead back to seasonal patterns, which have, again, if you don't have some type of seasonal tool in your trading arsenal, guys, respectfully, you may want to rethink that. So with that said, this is the Vantage Point AI Market Outlook for the week of January the 19th, 2026.